In this video, I'm going to talk very briefly about the cash flow statement. Keep in mind, I'm not going to talk here how to create cash flow statement. Rather, I want to explain what cash flow statement is and what kind of information does this cash flow statement content. Let's start with a basic question. That question is, what is cash flow statement? And this is a very general question you might have heard many times in the past in your introductory accounting class. And a statement of cash flow shows where the company gets cash and where that cash goes during a time period, usually a year. And this statement of cash flow tracks the company's cash flow over a period of time. So it shows how much cash did the company have at the beginning of the period, right? And how much cash did the company receive during that period, and how much cash did the company spend during that period. So the beginning period cash here, and how much it received during that period, and how much it spent during that period, and how much cash does this company have in the ending period. That kind of information is given in the statement of cash flow. Let me elaborate this concept with an example. Usually company involves in three activities: day-to-day business operation, and investing in fixed assets and long-term investment, financing business activities. Whenever they involve in each of these activities, the company either receives cash or spends cash. And whenever a company receives cash, it increases cash holding. So the cash received is a plus sign, and cash spent is a negative sign. So every cash it receives is going to increase the cash holding of that company. On the contrary, whenever it spends cash, it reduces the cash holding of that company. So on each of these activities, the company gets either cash or spends cash. Similarly, in financing activities, sometimes company might issue new bond, new shares. In that case, they receive cash plus, and sometimes they pay dividend, and sometimes they pay some portion of debt or all debt, and in that case, it's a cash outflow. So all these cash outflow in inflow in all these activities are recorded in the cash flow statement. Cash flow statement starts with recording cash flow from operating activities. It starts with net income, right? And makes cash adjustment due to depreciation and amortization, account receivables, inventory, accounts payable, and other operating cash flows. Usually this depreciation and amortization is non-cash received. Therefore, depreciation and amortization added back to net income, and the impact of all other items such as account receivables, inventory, accounts payable are adjusted to get cash flow from operating activities. Then the cash flow statement records cash flow from investing activities, and investing activities usually refers to purchase of plant and equipment, and also it includes long-term investment. Finally, cash flow statement records cash flow from financing activities. It includes cash adjustment for dividend paid, sale and purchase of stock, net short-term borrowing, and net long-term borrowing. So all these activities involves cash inflow and outflow, and all these cash inflow and outflow are recorded with the appropriate headings. And some of these cash flow from operating activities, investing activities, and financing activities reflects the changes in cash and cash equivalents, and that is reflected in the balance sheet. And finally, we can compute, or the cash flow in the statement shows the ending cash flow based on how much the cash flows was at the beginning and how much cash changed during that period and how much is at the end of that period. I have an example of an annual cash flow for an artificial company, and if you look at here, it shows on the top, so the cash flow from operating activities, and then it shows cash flows from investing activities, and it shows the cash flow from financing activities, and it shows what happened to the cash in each period. So that's a change in the cash. So the beginning period cash, and finally it shows closing, meaning end period cash. So this is what the statement of cash flow contains. So if in this example, if you look at here, it starts with net income, which is a part of cash flow from operating activities, and it adjusts for change in the working capital and other adjustment, and it gets the cash flow from operating activities, and then after it records the cash flow from investing activities, for example purchase of plant and equipment and other investing activities. Similarly, then after it records all these cash flows from this financing activities, like change in the short-term debt, change in the long-term debt, change in equity, dividend, all that affects the cash flow, and that is what is recorded in the third part of annual cash flow statement. And once you have cash flow from each sources, you can add these three yellow stripes rows, and you can get what happened the cash during that period. And we have the beginning period cash, and if you add the change in the cash to the beginning period of the cash, you get the end period of cash. That's what it shows us in the cash flow statement. And some of the information from this cash flow statement are going to be useful. For example, most often in investment we use cash flow per share, which is the cash flow from operation per share. And similarly, there are other ratios which I will be talking in another video. So this is all for now. Thank you.